Hello, this is Ernest Burley, your CIA, your cool insurance agent, back at you again with some more great information on insurance. Again, hey, I'm an agent licensed across the country. I have over 30 years experience. I have clients across the country, and I specialize in all areas of insurance, whether it be life insurance or auto insurance, homeowners insurance, long-term care, disability. My firm handles it all. The purpose of this podcast is to educate you, to enlighten you, and empower you so you can make the right decisions for you and your family with unbiased and objective information. I'm all about getting the right information into your hands so you can make the right decisions for your family. I would love to have everybody in the country be my client, but I understand that's not possible. But as long as you have the right information and you're able to make the right decisions, I'm a happy camper. So that's it for me. Let's get at it. Today's topic is life insurance, the good, the bad, the ugly. Because there's a lot of good, there's some bad, and there's some ugly. So we're going to address those three topics, okay? So the good, let's talk about the good real quick, okay? So the good, some of the good includes the actual living benefit. So some people have a policy that has a living benefit to it, which means it has a cash value feature. Because I've had several clients say, hey, I want a life insurance policy that's going to benefit me while I'm living, not just, my beneficiaries. So they have a cash value policy that's going to benefit them while they're living. They can take money from the cash value and do just about anything they want. Okay. When you pull the money out, it's your money. So you can renovate your home, you can buy a car, you can supplement your retirement, you can go on vacation, you can do a plethora of things with the cash value that's going to be in the life insurance policy based on what type of policy you get. So that's a good to life insurance. Now that's a permanent type of policy. Normally that's a whole life policy or some type of universal life policy, preferably a guaranteed universal life policy. We'll talk more about that later. So that's some of the good. Those policies do have a living benefit in them, so you can take advantage of that and take advantage of life insurance while you're still living, okay? Another benefit or another good in life insurance is beneficiaries, okay? So you're benefiting people who you leave behind, so if something unfortunate does happen to you, your beneficiaries, you're providing support and a legacy to beneficiaries because of the life insurance policy that you have. And also another good is the provisions from the life insurance policy that you'll be providing to your spouse, to your children, to your nieces, your nephews, your godchildren, to whomever you list as beneficiaries. You're providing provisions for them. So that's another good. So we have a lot of goods already, right? We got the living benefit, we have the beneficiaries, we have the provisions for those that you leave behind. So that's a lot of good within life insurance policies, but we're not done yet. You can also build generational wealth with life insurance. So you can build, I have some clients that by the time they retire, they're going to have hundreds of thousands of dollars of cash value in their life insurance policy. So imagine what they're going to be able to do with that. You can do all kinds of things for that. You can, help your children with a down payment for their house. You can put money away for your grandchildren. There are all different types of things you can do to create generational wealth in the life insurance policy. So that's another way. So now that's the cash value of the policy, but imagine the benefit itself. Even a small benefit, even a basic policy like $100,000, that's much better than zero. Okay. So imagine leaving your family with nothing versus $100,000. That goes a long way. But imagine you have $500,000 or $1 million of protection. Just imagine what type of generational wealth and generational provision you're providing for your family. Very important to think of it that way. And you have to do what fits in your budget. So we talked about the difference between like the term coverage being very inexpensive, but going up substantially after the term, and whole life insurance and universal life, the guaranteed universal life. So we talked about those different ways to lock in some type of coverage to make sure you're maintaining the status quo of your family if something unfortunate happens to you. Now, another good on life insurance is a locked-in benefit. Now we talked about this. Now the locked-in benefit is whole life insurance, right? Or guaranteed universal life insurance. So you can lock in your benefit for life and lock in your premium for life, which means you don't have to worry about your premium changing and you don't have to worry about your benefit changing at all. So that's another good for life insurance. You can lock in those benefits, lock in that premium, and not have to worry about it. It's on autopilot. As long as you make your payment, your policy is good to go. Here's another good in life insurance. you can do a limited pay option. So some people are like, they don't want to pay for life insurance their entire life. So they pay it off early. They'll do like a pay to age 65 or a 10 pay or 20 pay or 30 pay, as opposed to paying to, age 100 or whatever. You can pay it for a certain period of time and pay it off early. Now, the advantage of doing that is that the policy's paid off early, right? It's just like paying off your house. And you keep the policy. So it's like you pay off your mortgage, right? You still own the house and you have full equity in the house. The same thing with your life insurance policy. If you pay it off early, you don't have any more payments. You have no more like a mortgage note, right? You don't have any more life insurance payment note because it's paid off, but the cash value continues to grow in those policies. So that's another good for life insurance. You can limited pay it and pay it off in a shorter period of time. Of course, that costs a little bit more. It sounds like it costs more. It costs more in the short term, but in the long term, it costs you way less. You'll save thousands upon thousands upon thousands of dollars by paying it off in the short run, because you do pay a little bit more in that short run, like you think that way. But if you paid it to age 100, you would have paid tens of thousands of dollars more, as opposed to, if you just paid it off in 10 years, okay, or 20 years, okay? Now, here's another good. You can convert term policy. So if you get stuck in a term policy, every policy serves its own purpose, okay? So if you have a term policy, you can always convert that policy. Well, I'll say most companies allow you to convert that policy into a permanent plan of protection. And here's the great thing about that. It's without any medical underwriting. So regardless of what your health is, you can convert that policy into a permanent policy that you can keep for life, instead of having it blow up on you after 30 years or 20 years and not having any coverage at all. So that's one great benefit. No medical underwriting at all. So it doesn't matter what kind of health you're in at that stage, they will automatically convert that, or it's just signing paperwork. That's all, going from a term policy to whole life or guaranteed universal life or what have you. Now, here's the second benefit. The second benefit is that in addition to being able to convert it without a medical underwriting, you can also convert it at your discounted rate. So say, for instance, you got a preferred rate when you were 20 or 30 or 40, whenever you got the policy, that rating on your health carries over to the new policy. So you don't have to qualify for a better rate. If you already have a discounted rate, it carries over even though you may not be in the best of health. That rating that you have on that current policy carries over to your permanent policy. That is a sweet deal, okay? Now, the next good, a lot of goods. I'll tell you, it's a lot of good with life insurance. We're going to get to the bad and ugly in just a minute, okay? So here's some more good. There's some riders that you may want to take a look at. So the guaranteed insurability option, and I'm going to have a different podcast that go over like some riders that I really like that I think you should take advantage of. So a guaranteed insurability option, or some companies call it guaranteed insurability rider, it guarantees the insured the ability to get more coverage later on in life without a medical exam. That's a sweet deal. So I advocate that for all children's policies. As a matter of fact, I don't even provide it as an option for people. I just automatically put it on policies when it's a young adult or a child. And the reason why is because, like, give you an example. So if you have say a teenager or a child that you say $100,000 policy you wrote for them, and put $100,000 guaranteed insurability option, that guaranteed insurability option gives you the option to get more coverage later on in life, and it's normally from the mid-20s to the mid-40s of the child. And it's normally about 8 option years. They're called option years. So at age 25, that's normally when it starts. They send out a letter, called a conversion letter, and say, hey, you got this policy, it has this option on it for you to get more coverage at age 25. You're at age 25 now, so they send the letter. So 25 is the first, and then every third year thereafter to like age 46. So that's 8 option years. Let's count them off. Age 25, 28, 31, 34, 37, 40, 43, 46. That's 8 option years. And some companies go to 49. So 8 option years. So the child has a $100,000 policy. You put the GIO or GIRO on there, right? The guaranteed insurability option or guaranteed insurability rider on the policy for another $800,000 of coverage that child can secure throughout their lives. Tell me that's not a great deal. That's $900,000 of coverage basically without a medical underwriting, because if you got the policy when the child was a minor, basically, I mean, it's not much underwriting on children's policies at all. I just wrote one just a couple of days ago. It's probably going to be issued like in a day or two, because a child is normally in good health and they just send those policies right on through with no problem. So no underwriting for the 100,000 and no underwriting for the additional 800,000. That's a sweet deal. So guaranteed insurability option, that's some of the good, right? Another good, CTR, children's term rider. That's a rider you can add onto your policy as an adult. So when you have a newborn child, they automatically have coverage, and they come in units. It's called units. So the units are normally $1,000, and most companies allow you to add up to 10 units or $10,000 onto your policy for the child, and it goes automatically in force on the child after 15 days. So after 15 days, that policy automatically is available. Well, I shouldn't say policy, it's a rider. The rider on your policy automatically covers that child and each child that you have. Now, also, if you adopt a child, that's included because that's your dependent. So it's $10,000 of coverage. Some companies may go up to 20 units or 20,000, but most stay at that 10,000 mark. And it's a rider. So you remember, it's a rider, it's not a policy. So by the age of 25, you'll want to convert that rider into an actual policy. Most companies do allow you to do that. Convert that rider into an actual policy. So the child will have an actual policy as opposed to just being a rider that's going to expire when they're 25. Okay. So there's another good. So we're ratting off these goods. We're going to get to the bad and the ugly in just a minute here. I'm almost done with the goods. Now, there are more goods, but I just have these last two. The ADB, accelerated death benefit. That's a rider. I don't think I recall any policy that doesn't have that rider in it. It's called the accelerated death benefit. And basically it gives the insured access to up to 50 or 75% or more of their policy while they're still living, right? Now, that's only if you've been diagnosed as being terminally ill. So say you have a $100,000 policy, you can access $50,000 or more, $75,000 or more with some companies of that policy while you're still living if you've been diagnosed as terminally ill. And terminally ill basically means you're expected to pass within 1 year or 2 years with some companies. Different companies have different criteria. So that's another good. You can use the policy while you're still living under that ADB or accelerated death benefit rider. Here's another good. You can save age. And save age means if you're within a few months of your birthday, say you just turned 40 and you were 39 a couple of weeks ago or a month ago or 2 months ago, you can reach back. You can have that life company. You can say, hey, I want to save age. If your agent hasn't told you about it, see, that's why you're listening to your CIA, your cool insurance agent, right? Because I'm telling you about it. Ask your agent to save age and give you your previous age locked in on that policy. So instead of being rated at 40 years old, you'll be rated as a 39-year-old and save tons of money over the life of the policy, right? Because you'll lock in at the younger age and you'll be paying the premium of a 39-year-old, not a 40-year-old, for the life of the policy, basically. So you'll save a lot of money by locking that previous age in as opposed to just being issued at your current age. So save age, that's another benefit or another good in life insurance policies. That's a sweet deal. You got to take advantage of that. So that's the good. Now, okay, we got to get over to some of the bad, okay? Here's some bad. You have the wrong policy. You thought you had one policy, but you have another policy. That's really bad. And I see that quite often. Like I said, I just wrote a policy for a client that happened to, and I write policies for clients all the time because here's what happens. A client will tell me they got a policy or someone will refer them to me because they don't understand what's going on with their policy. And as they start talking about a policy, I can pretty much tell what it is. I've been in the industry over 30 years, so I kind of know. And I have, I've had clients tell me, yeah, I got this policy from my mom 12, 14 years ago. And now they're saying I'm not paying enough money into it and it's going to lapse if I don't pay more money. I said, yeah, that's a universal life policy. No, I think it's a whole lot. I'm not sure. I was like, it's universal life. It's a traditional universal life policy because that's what those policies do. They're notorious for doing that. When you start getting into your 60s or 70s, or sometimes even 50s, it's going to start conking out on you and you will have zeros. I'm going to have a podcast. I'm going to talk about how to read an illustration. So you'll see how the policy actually functions. So before you even get into a situation where you're signing an application for life insurance, you know how that policy is supposed to perform over time. Look at the illustration first. Always have the person send you an illustration so you can review it, or you can email it to me. I'll review it and explain it to you. So, but they should explain it to whoever the agent is should explain that to you. So there you go. Okay. That's a bad. having one type of policy and you think you had another type of policy. And I see that notoriously with universal life policies. And like I said, I see that all over the country from different people. In my local vicinity here, my firm is in Bowie, Maryland, to clients all over the country. I see that all the time. I have clients in California, Nevada, Florida, just everywhere. And I'm having to like get clients situated because they think they have a permanent policy locked in and they don't have to worry about the rate anymore. But when I review that illustration with them, I let them know, I say, keep going down and look for the zeros, look for the lapse, LAPSE. And they get freaked out because they're like, what in the world? There you go. That's why you have to come to your CIA, your cool insurance agent. Okay, so here's another bad, a change in premium. So normally this happens at the least opportune moment. Normally the change in premium happens like later on in life when you're older and you can least afford it, right? Or you have some health condition maybe. And this is notorious for group policies too. So don't rely on group coverage. I'm going to do another podcast on that. So if you realize that your policy is not locked in for life and now you're 30 years older, that's bad. That's bad. Okay, let's not get ourselves into that type of situation because it's just a bad situation. You're older, it's going to cost more, your health situation. So let's not do that. Also, change in benefit. Here's another bad. We have a change in benefit. That's another situation with group policies because most times you can't even take the group policy with you because if you're not part of the group anymore, then you can't have the group coverage, right? But some companies will let you take the policy if that's the exception. But the two things you need to ask is, okay, when is the premium going to change? So when I leave this group, how is that going to affect the premium? Is it going to affect the premium immediately? And then on down the line, how is the premium going to change while I'm owning this policy? And then how is the benefit going to change? Is the benefit going to decrease in value? When is it going to decrease? Is it going to decrease down to zero or will it decrease down to some minimal amount? These are some of the bads, right? The change in premium, the type, not having some type of policy you thought you had, but you don't have, right? And also having a change in benefit. And normally this stuff happens at the most inopportune time. And we don't want that to happen to you. Here's another bad, overpaying for a policy. And it's called overfunding or the bank concept. I'm not a big fan of that. Now, some people that could be okay for, but for 99% of people, it is not. Most people don't have this extra cash to toss into a life insurance policy because my opinion is that they are foregoing the opportunities to make better gains and do better things with their money when they're dumping it into a life insurance policy. So most people don't have extra money to do that with. Now, if you've taken advantage of other plans that can, and you maximize the opportunities to capitalize on other plans that do better for your money, then okay, I can see you putting more money into a cash value life insurance policy and building to get tax deferred that way, because that's an advantage of the cash value that grows into a life insurance policy. It is tax deferred. But my problem with people doing the overfunding and banking concept is that most of these individuals have not maximized other plans that can do better for their money. That's where I have the issue with that. So there are usually better ways for you to take advantage of growth on your money or protecting your money or what have you, as opposed to dumping it all into a life insurance policy. So that's it with the bad. Now the ugly. Oh boy, the ugly. There are some bad agents out there. I hate to put it this way, but there are some bad agents out there that intentionally sell policies that are not in your best interest. They're more looking out for their own best interest, looking out for their own commissions. So you have to discern, who these individuals are. And I'm not calling people out, but I just don't like when people are misinformed and they're put in the wrong policy. They're told or led to believe they have one policy. I have one client. I've had several clients that they think, some clients want a policy with a long-term care rider on it. I've had clients who thought they had that on their policy, but they did not. And they were told that, but they were told a different way. They were told some other kind of slick way about it, but it was not a long-term care rider, right? And that's what the person wanted. That's what they directly asked for. If that's not something you provide life insurance agents, just tell them you don't have that and explain to them clearly that this is some option or alternative that you have. Don't lead them to believe that they have a long-term care rider or some other feature or option of the policy just because you don't have that product. Okay. And that's what ends up happening. So I have an acronym for this. You want to make sure the person is in the choir or singing from the choir, singing the right tune, however you want to do it. You want to make sure the person you're dealing with in any profession for the most part, but especially if you're dealing with someone who's dealing with your money and your financial planning and things of that nature, like estate planning, your life insurance and stuff like that, make sure they're in the choir, okay? And by choir, it's an acronym. The C in choir stands for credentials and certifications. So of course you want to make sure the person is licensed to have some kind of credentials to talk about what they're talking about and not just be talking to someone who's just read something in a book or heard about something. No, you want to deal with someone who has the actual credentials and licenses to actually speak to that and take care of that for you, whatever that plan may be. Now, in addition to the credentials and certifications, in addition to the credentials, you want them to have some kind of certifications ideally too, not just the base minimum, just, okay, I got the life insurance license, that's it. Ideally, maybe a little bit more education in the field. That's ideal. So they have a deeper knowledge. So certifications and credentials, that's the C in choir. The H in choir stands for hours of experience. I couldn't think of an E word for H word for experience, so I just said hours of experience. So, experience does make a difference. So if someone has been in the industry for an extended period of time, they should have a deeper knowledge of things and know the ins and outs better. And I'm not knocking people who are new to any industry, but it makes a difference whether someone has just a week or a month or a year of experience versus someone who has maybe a couple of decades of experience. That makes a pretty big difference, I think. So hours of experience, that's the H in choir. The O in choir stands for objective. And this is where I'm getting back to, if the agent doesn't sell this type of product or has the type of product for you, then they just need to let you know. But if that's how they earn their living, then more than likely they're going to try and squeeze you into whatever they have. So you want to make sure they're objective and they don't have an ulterior motive. They don't have just one product or service to offer you. Because if they just have that one product or service to offer you and that's how they make their living, guess what? You're going to get that one product or service offered to you on a platter. They're going to want you, if you come to the room with some money, they're going to say, okay, well, let's put your retirement planning in there. You can fund your children's education. You can put your emergency savings in here. Everything's going to go into it. And that's not looking out for the client's best interest. That's looking out for the agent's best interest to say, okay, I need to get as much of that money into this policy as possible because that's how I earn my living. That's not objective. You want someone who is objective and they have more than one product or service to offer you. That's the ideal. The I in choir stands for independent. So you want to make sure that they're independent, which means they have more than one company to offer you. So if they're just writing, say if they just say, oh, this is the life company, this is it. This is the company I write for and that's it. Got this one quote. No, I mean, there are a ton of companies out there. There are dozens and dozens of companies. Some companies have better rates for whole life. Some companies have better rates for term life. Another company has better rate for universal life. And then some companies are better at $1 million of coverage and some at $100,000 of coverage. Some companies are more conservative with their underwriting, so they don't take on much risk. You have to be very healthy. And some companies are more progressive or liberal, and they'll allow certain ailments and conditions, and they'll write you. So you want someone who's going to do the research for you and have access to dozens of life insurance carriers instead of just one. Because that's not someone who's singing from the choir, and they can't look out for your best interest if they just have that one type of policy to offer you. Okay, because there are dozens of companies out there and they all have different appetites, and you want to find out which one has the appetite for you. Okay, the R in choir stands for regulated. So you want to make sure whoever is providing the service for you is regulated. They have some type of regulations. So they are accountable to somebody, right? Some state body or some federal body or some local, they have some type of oversight of or so if they do or say something wrong, that they're regulated. Okay, so you want to make sure of that. And also you want to make sure they have a good reputation. So that's the second R and choir. So make sure that whoever you're dealing with is singing from the choir. Hallelujah. Okay, so here's another part of the ugly, and then we're going to be done with this. Policy expirations or like premium increase, like drastic premium increases. So policy expirations, that's an ugly, right? Because the policy expiration normally occurs, like I said, when you least can afford that to happen. When you're older, now you're 60, 70 years old, and you want to get some type of coverage, you're older, you're more likely to have health conditions. more likely to become ineligible for one reason or another. So policy expirations are really bad. It's just really bad. That's ugly, because that means policy expiration, then you have no coverage. And for one reason or another, either the policy has expired because it's met its term, which is unlikely, because if you have a term to like age 85 or 95, I explained in another podcast, there's no way you're going to keep the policy that long, because the rate is going to be too phenomenally expensive after whatever your initial term was. And if you have a universal life policy that's going to expire or terminate because you're not feeding the beast, you have to continue to feed that premium, and it increases the older you get. That's not a good situation to be in. So get the right policy from the jump and don't find yourself in that situation. That's it for this podcast. I spent a little bit more time than I wanted to, but I hope you got some good information. Just to recap, life policies are good. Life policies are good, okay? They only turn bad or ugly when you either have the wrong policy or you deal with the wrong agent, okay? Takeaways: make sure you're dealing with someone from the choir. CHOIR, a person who has credentials and certifications, person who has a good amount of hours of experience. The H inquire, the O inquire, they're objective, so they have more than one product or service to offer you as opposed to just one. The I, independent, more than one company to offer you, right? The R is regulated, okay? So make sure they're regulated and have a good reputation. So that's the R inquire, CHOIR. Make sure that that person is singing from the choir. Hallelujah. Okay. Very important. That's it. If you want to connect with me, ernestburleyjr@gmail.com. That's the easiest way to connect with me. Very easy to connect with me. Okay. It's my full name @gmail.com, or you can call my firm at 301-262-2600. Again, that's 301-262-2600. I'd be delighted to help you out with whatever your situation is. And even if you just have a question, it's no big deal. I'm not a pressure guy. I just want you to have the right information. So reach out, I get you the right information. You make the decision on your own as to which direction you want to go, but make sure you have the right information so you can make the right decision. Okay. This is your CIA, your cool insurance agent, Ernest Burley, signing off. Until next time, take care.